My name is Bert Salazar, and I'm going to be your host for this tax planning webinar. I'm very, very excited to have all of you here. For those of you that are actually watching us on Facebook Live, please, I would love for you to like and share and make some comments on a lot of the information that I'm going to be providing. This is not going to be a very long webinar, but it's going to be a tax planning webinar. And the key feature about this tax planning webinar, which is something that the vast majority of Americans are not aware of, is how can you distribute your IRA and your 401k on a tax-free basis at retirement. See, for those of you that have been following me for years, you know that there are three different tax buckets in the IRS code. You have the taxable bucket, you have the tax-deferred bucket, and you have the tax-free bucket. Now, on the tax-deferred bucket, the money that goes in is pre-tax. The money grows on a tax-deferred basis, and then when you pull the money out, it's totally tax-free. And that bucket, and it's totally taxable upon distribution. So the money goes in pre-tax, the money grows tax-deferred, and then when you pull it out, you have to pay taxes on the whole thing. So the vehicles inside of that tax-deferred bucket are your IRAs, your 401ks, your SEPs, you know, your pensions if you have any, and so forth. But there's a way that in a perfect world that you could have your cake and eat it too, in which you can put money into this bucket on a tax-deferred basis. The money can also grow tax-deferred, but then when you pull it out, you can pull it out tax-free. But in order for you to do that, you're going to have to do a lot of tax planning. So what I want to do tonight is I want to walk you through the process of how you're able to maximize your tax benefits in retirement. So for those of you that are 5 years, 10 years away from retirement, for those of you that may already be entering retirement in the next 6 to 12 months, I think it's going to be very, very important for you to stay till the very end so you can truly understand how to maximize your tax benefits in retirement and how to minimize all of your tax liabilities at the most important time in your life. So what I'm going to do right now is, without having to wait any longer, I know that we're getting more and more of you to log in right now, and I can see it. And by the same token, for those of you that are following me on Facebook, again, please make sure that you share and that you hit like if you like this information, and that you can make comments, because it's going to help all of us, because we're going to get more and more people to actually watch this webinar along those lines. So let me take you right to the presentation that I'm going to be making to you. You should be seeing it very, very soon. And let me get right into it. Again, for those of you that are just joining us, welcome to the webinar. Again, my name is Bert Salazar, and I'm going to be your host tonight. This is a tax planning webinar on how to distribute your IRA and 401k tax-free in retirement. Now, most of you have never heard this, so I'm going to get right to it, because there's a lot of information that I want to give you in order to help you maximize all of these benefits at some point in time in the future. Now, first thing I want to share with you is that I am a certified financial education instructor. So obviously the work that we do in my firm is to provide education to all of you, because we feel very strongly that information without education always leads to failure. So the more education that I can provide to all of you, the better off you're going to be when it comes to your financial decisions, not only now, but also in the future. As a firm, we do three things, and three things only, and we do them very well. We do tax planning, we do insurance planning, and then we do alternative investments. The vast majority of the clients that come to see us for the first time, they come through our tax planning program, meaning that they want us to do their tax preparation for the year. They may want us to do some auditing of their tax preparation or their prior year's taxes, so we're able to do that. Some come in because they want to do some tax forward planning or tax planning along those lines. So the vast majority of the clients that we engage for the first time come through the tax planning side of the house. And that's very important, because if I can help you reduce your tax liability, then you don't have to take any risk in order to do that. So my number one job is, how can I reduce your tax liability, not only now, but also in retirement and or in the future. Then obviously the insurance and the investment side comes into play later on. Now, the vast majority of the competitors that you see in the marketplace, some of them do insurance, some of them do investments, some of them do a combination of both, but very, very few have the ability to do tax planning, insurance planning, and alternative investments. Again, that's all about me, because it's not about me tonight. Obviously, for those of you that may want to reach out, because you may have some questions at the very end, or you may want to reach out to me in the next day or so, obviously you're going to have the ability to do so. But I want to get into what I consider to be a perfect retirement plan. And if you were to sit down and have the ability on a canvas to draw what a retirement plan should look like, I would imagine what you see in front of you should be it. Number one, you want guaranteed income, because the more guaranteed income that you have in retirement, the better off you and your family are going to be. Second thing, you want longevity protection. So not only do you want that guaranteed income, but you also want that guaranteed income for life. Not only for your life, but you also want to provide it for your surviving spouse's life as well. You also want that income to have some kind of inflation hedging. You know, in a 20-year period, inflation, which is a silent killer, by the way, because inflation is not tax deductible, inflation can actually kill approximately 55% of all your retirement income. So that means, you know, that if you earn $1 today at a 3% inflation rate, you have to be able to earn at least $1.03 next year in order to stay ahead of inflation. On top of that, since inflation is not tax deductible, you can not only earn that 3%, you got to earn north of that based on your tax bracket, so you can net 3%. Another way to put it is that $1 today can only purchase at a 3% inflation discounted rate, can only purchase 97 cents worth of goods and services at some point in time next year. Obviously, the next thing that would create a perfect retirement plan is to have tax-free income. So it's not only the fact that you want guaranteed income, then you want that income to be guaranteed for life, and also you want it to have some inflation hedging, but most important, you want either all of it or the vast majority of that income come to you and your family on a tax-preferred and on a tax-free basis. Next, obviously, because of the fact that people are living so much longer today than ever before, there's a very high susceptibility for people to living with disabilities, Alzheimer's, Parkinson's, strokes, having the ability or the need to go into an assisted living facility or a nursing home. It is very, very expensive today. So fast forward 10, 15, 20, 25, 30 years down the line and figure out what that cost is going to be. So you need to make certain that any type of retirement planning that you have also has taken into consideration longevity and long-term care planning and hedging along those lines. And then last but not least, you want to make certain that upon your death, that income that you have been generating can go through onto your surviving spouse so that he or she can maintain their standard of living for the rest of their lives. Now, obviously, because of all these things that I have just talked to you about, tax planning is becoming very, very important. And it has become a very critical issue for the vast majority of Americans, because there's a major, major tax train coming down the railroad tracks, and the tax train is in the form of the doubling of taxes at some point in time in the future. Now, you see there in front of you a photograph that I just took a couple of weeks ago of the U.S. debt clock. If you look on the top left-hand corner, our national debt is now at 22 trillion. It actually hit Valentine's week. It hit $22 trillion in national debt for the first time in the history of our country. Now, if you think that's a major problem, Take a look at the national deficit. You know, it's now approaching $1 trillion. That means that, you know, we're bringing in $1 trillion less than what we're paying out. Obviously, there are a lot of programs that the government has been paying for many, many years that are now catching up to us. So a lot of these benefits that you see in the government, something's going to have to be done down the line, because you can only kick the can down the road so long until you actually run out of road. And then, you know, like if you borrow from Peter to pay Paul, everything is fine until Peter runs out of money. So when you factor in the $22 trillion in national debt, when you factor in the $1 trillion of deficit between what we're bringing in and what we're paying out, and then if you go to the very bottom toward the center of this slide, you will notice a number there, which is actually in excess. It's a big number. Let me put on my glasses to make sure I give you the right number, but it's actually the $122 trillion of unfunded liabilities that we have in our country. For those of you that may not know this, the unfunded liabilities are those liabilities and those promises that the U.S. government has made to all Americans that they don't have the money to pay for today. So when you factor $122 trillion in unfunded liabilities, that would cover Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt, and you factor that in, and you couple that with the $1 trillion in deficit and the $22 trillion of the national debt that we're living through today, there is no doubt in my mind that taxes are going to have to double in the future, or our country is going to go bankrupt. So the tax strain is coming. You have to do your due diligence. You have to plan. You cannot wait until tomorrow to start planning, because the train is coming and you're not going to be able, or you're not going to have the time to get out of the track. Now, let's talk a little bit about Social Security, because a lot of the issues that we're seeing with this tax strain has to do with Social Security. You see, Social Security started back in 1935, and it was a beautiful program at that point in time. The reason for that is that for every person that was retired in the U.S., there were 42 Americans working. For those of you that may not know this, Social Security is a pay-as-you-go system. That means that those of us that are working today are paying for those that are already retired. But in 1935, retirement age was 65 years of age, and that was a good thing. The bad thing is that mortality back in 1935, which was age 62. So you couldn't retire until you were 65 years of age, but then mortality was at age 62. And by the way, if you were one of the lucky ones and you actually made it to age 65, there was a high probability that you were going to be collecting on Social Security benefits for 2 to 3 years at the very most, and then you were going to be passing away. Now, fast forward today. Look at 1964, the ratio was 10 to 1. 1985, it was 5 to 1. Today, the ratio is 3 to 1. That means that for every retiree in the United States today, there are only 3 people working, as opposed to 42 back in 1935. So Social Security looks totally different today than it ever did back in 1935 or even in 1964 when we had a 10 to 1 ratio. That brings all kinds of different issues and concerns. And by the way, Social Security is not as bad a problem as Medicare is. We just don't have the time in this webinar tonight to cover that. Now, David Walker, who was a CPA, Comptroller General of the United States, he actually worked for Clinton and Bush at the same time. He basically said in 2008 that unless taxes are to double, our country was going to go bankrupt. And you're going to see, I'm going to show you in a slide in which taxes are actually at the 3rd lowest level in the history of our country. So think of it this way. We have the most amount of debt that we have ever had in the history of our country, and we're actually at the 3rd lowest historical tax rates that we have ever seen. Now, obviously, that's going to tell you a big story for the future. Obviously, the story is David versus Goliath. And each and every one of us, each and every one of you is David. And unless you start doing some planning today, there's a very high probability that that train is going to run you over. Yes, President Donald Trump signed into law the Tax Cuts and Jobs Act that took effect January 1 of 2018. So we have already gone through an entire year. And in the Tax Cuts and Jobs Act, or the TCJA, taxes, the standard deductions have been increased, and for the vast majority of Americans, the tax brackets have been lowered, so the tax liabilities are lower for those Americans today, most Americans today, than they were back in 2017. For that reason, you only have a 7-year window now. And the reason for that is because the TCJA, the new laws, they sunset December 31st of 2025. So when you wake up January 1st of 2026, the law goes back to the 2017 law, which the deductions were lower and then the tax brackets were higher. But I'm not too concerned about 2026. I'm mostly concerned about 2028 and 2030 because that's when we're going to start feeling the major impact of Social Security and Medicare along those lines. So you better be ready. You have to start doing tax planning today and do not wait for another single day before you either contact your financial advisor or feel free to reach out to me if you have any additional questions. Now, there are three, as I said at the very beginning, the IRS has three major tax buckets. You have the taxable bucket, the tax-deferred bucket, and the tax-free bucket. The taxable bucket is the bucket where the money that you put in is after tax, that the money gets taxed every year. And the reason why you know that is because you're gonna receive a 1099 from the financial institution that has your money telling you that you got to report it for taxes. And then when you sell your assets inside that bucket, you have to pay taxes again. Now, from a taxable perspective, the taxable bucket is not very good. But on the other hand, from a liquidity perspective, it is very, very good for you. So I do highly recommend for the vast majority of my clients that you need to have a certain amount of assets in the taxable bucket in order to make certain that you meet certain liabilities, emergencies, business opportunities, or whatever that may be. But because every single dollar in that asset is going to be taxed, then obviously you need to have the optimum amount of assets in the taxable bucket. Now, the tax-deferred bucket I just covered for you. Those are your IRAs and your 401ks and your pensions and your 457s or your deferred comp if you happen to be a public employee. The money that goes in is pre-tax. The money grows tax deferred, but then when you pull the money out, you have to pay taxes on the whole thing. But I'm going to share with you how it is so you can avoid paying taxes on some of that money coming out of that bucket if you do proper tax planning. And then last but not least, your tax-free bucket. That is a bucket that is at least understood, and that should be the bucket that should be totally optimized. The same way that you want to optimize and have optimum amounts in your taxable bucket and your tax-deferred bucket because of their tax liabilities, the optimum bucket, you should be able to put the vast majority of your assets in that bucket if you want to live a tax-free retirement life in the future. Now, some of you may say, you know what, Bert, am I not going to be in a lower tax bracket in retirement? And by the way, I get that question often from many of you. And my answer is always the same. If you've been a financial failure in your entire life, then there's a high probability you're going to be in a lower tax bracket. But if you've done fairly well for yourself and your family, it's going to be slim to none for you to find yourself in a lower tax bracket. Why? Because when you hit retirement, a lot of the deductions that you were taking, like your mortgage deduction, your kids, that are hopefully going to be out of the house. And even if they're not out of the house, the IRS is not going to allow you to take a deduction for them. But you're going to start to lose those deductions because your home is going to be more than likely paid for by the time that you retire. Or, if you're in the last 2 to 3 years of a 30-year mortgage, the vast majority of the payments that you're making are going toward principal. So you're not going to get such a high deduction. Obviously, you're not going to be making, because of the fact that you're going to be in retirement, you're not going to be making contributions to your qualified plans, your IRAs, and your 401ks. And last but not least, those charitable deductions that you were making prior to retirement, now when you retire, you're going to start shifting many of those, and many of my clients have done this over the years. They start shifting. Instead of making charitable contributions, they devote more of their time to charity. The problem is that the IRS doesn't give you a tax deduction for your time. So if you start to either reduce the amount of contributions that you make to a charitable organization, or you eliminate them altogether, then obviously there's a high probability you're going to lose that as well. So even if taxes were not to go up in the future, which there's no doubt in my mind that they're going to have to, you may actually find yourself in a higher tax bracket because you're going to be losing all of those deductions, exemptions, and credits that are going to be so critical for you in retirement. Now, there are 4 vehicles under the IRS code that receive federal income tax-free status. And those are your Roth IRAs, your Roth 401ks, your municipal bonds, and last but not least, your 7702 plans, which are your cash value life insurance policies, which enjoy enormous benefits under the IRS code. Now, although I just mentioned that there were 4 vehicles under the code that receive a tax preferential treatment from a federal income tax standpoint, it doesn't mean that they're going to receive a tax preferential treatment in everything. Now, the only 3 vehicles under the code that do receive preferential treatment from all sources of taxation are the following: your Roth IRAs, your Roth 401ks, and your 7702 plans. You notice that I left out the municipal bonds because although you receive municipal bond income on a federal income tax-free basis, you may have to pay state income taxes, you may have to pay capital gains taxes, and most important, the income that you receive will be added on to the provisional income calculation that we will discuss in the next few minutes to determine what percentage of your Social Security benefits is going to be taxed in retirement. And yes, for those of you that don't know this, your Social Security benefits may very well be taxed in retirement, and there's nothing that you can do about it unless you've done proper planning. Now, just to give you a little bit of feedback on IRAs and 401ks and how they work, obviously the money that you put into a Roth IRA or a 401k grows tax-free when you put the money in, because you put the money in after tax. You also have the ability to take tax-free distributions. Again, because it's a Roth 401k and an IRA is controlled by the IRS, so they're going to be limited contribution amounts. Some of you may not be able to contribute at all. If you don't have earned income, you cannot put money away into a Roth IRA or a Roth 401k. Many a times, if you make too much money, like a Bill Gates, he cannot contribute to a Roth IRA. So it really depends on your filing status. You have no access to your money prior to age 59 and a half. Unless you can identify certain emergencies, and there are very few of them, but for the most part, once you put money into a Roth IRA or a Roth 401k, you have to abide by the 59 and a half rule, where there may be a 10% penalty if you try to take money out prior to that, especially on the growth of that money. The good thing about Roth IRAs and Roth 401ks, once you transfer that Roth 401k to an IRA, is that there's no required minimum distributions. You see, in IRAs and 401ks, once you get to the age of 70 and a half, you're not going to have a choice but to start taking distributions out of those accounts. And if you don't take distributions out of a Roth 401k and a Roth, and if you don't take distributions out of your traditional IRA and your traditional 401k, when you hit the age of 70 and a half, you're not only going to have to pay taxes on the amount of distribution that you should have taken but you didn't take, but you're also going to have to pay a 50% excise tax penalty, and the IRS is going to penalize you on that. And they're very, very serious about that because they want to start to get their money at this point in time once you get to age 70 and a half. So the only time that you have any flexibility in your IRAs are between the ages of 59 and a half and then the ages of 70 and a half. Anything in between that, you can do whatever you want with your money. Prior to that, there may be a penalty, and post 70 and a half, you will also have a penalty as well. No Social Security tax triggers, and that's a good thing. That means that the income that you're generating from your Roth IRAs and your Roth 401ks will not be factored in to your Social Security calculations. And obviously, they're creditor protected, so that's very, very good for all of you. Now, municipal bond funds, obviously the money, the growth of that money is tax-free. You can take tax-free distributions. You can have access to your money at any time. You don't have that required minimum distribution at age 70 and a half. Obviously, it does trigger Social Security penalties and or liabilities, and we'll discuss those in the next few minutes. There's no credit protection for that as well. 7702 plans, which are the cash value life insurance plans where you can actually put a lot of money into. And most of the 7702 plans that I do for my clients are actually done totally the opposite of the vast majority of you that buy life insurance. See, most of you, when you purchase life insurance, you want to buy the most amount of death benefit for the least amount of premium possible. In our case, when I'm using 7702 plan as a supplemental retirement plan, I want to buy the least amount of death benefit and be able to put the most amount of money into it possibly and possible that I can in order to maximize the internal rate of return on that contract. So obviously there's a tax-free death benefit that comes along with your 7702 plan because it is an insurance contract. The money inside that plan grows on a tax deferred basis. You can also take money out on a tax-free basis if you do it the right way. You can also transfer and have no death benefit taxes on the estate planning side if you do it the right way. Traditionally, death benefit proceeds are federal income tax-free, but depending on your net worth, obviously there may be an estate tax liability, but for the vast majority of you that are watching and listening to me tonight, it's not going to be a liability for you. You can have access to your money prior to age 59 and a half, just like you would in your municipal bonds. And you don't have that required minimum distribution at age 70 and a half, which is another critical aspect of what you have in your Roth IRAs and your municipal bond funds. By the same token, they're creditor protected in the state of Florida. Depending on where the state you live in is, obviously the rules of engagement may change a little bit, so make certain that if you're not in Florida, that you check where the state that you're in and whether there is credit protection and to what level for 7702 plans. They're also self-completed in case of death and disability. So if you happen to die tomorrow and you have been putting money in there for 2 to 3 years, the death benefit is more than likely going to replace your income and or provide additional assets to your surviving spouse and your beneficiaries along those lines. Many of these 7702 plans that I do for my clients do include a long-term care benefit, which is very, very critical for the vast majority of you listening to me tonight. Obviously, you can get competitive rates of returns because, you know, there's so many different flavors of ice cream that you can invest when it comes to 7702 plans. There are no Social Security triggers. That's a win for all of you. Obviously, there are 30 different ways you can use these contracts. And traditionally, when it comes to designing a 7702 plan, the insurance company is going to determine the minimum premium. The IRS is going to determine the maximum premium. And we at Gable's Tax Planning Group will work with you to determine the optimum premium to your 7702 plan, in addition to whatever you're doing on your Roth IRAs and your Roth 401ks, in order for you to create a totally tax-free retirement life for you and your family. Now, obviously, and this is primarily for people that are married filing jointly, as you can see there, the tax brackets have been reduced. So the 12 used to be the 15, the 22 was the 25, the 24 was the 28 under the old tax law, the 32 was the 33, the 35 remained the same, and the 37, which is the highest marginal tax bracket that we have today, was 39.6 at some point in time. Now, also remember that January 1 of 2026, unless Congress decides to do something else, obviously, those numbers on the right will now become the effective numbers starting in January 1st of 2026. So any tax planning that you're going to do, you might as well do it today. And again, for those of you that do your own taxes, although I may not recommend you do that if you're going to do some tax planning, then obviously those are the amounts of money, depending on your tax bracket, that you would pay moving from one bracket to the next bracket and so forth. Now, capital gains, obviously, because of the fact that, you know, whenever you get a capital gain distribution, there must have been a susceptibility for a capital loss. So in that case, the IRS is basically saying to all of you that if you're willing to invest and put your money at risk, then if you make a gain or you receive a gain, then you can benefit from a capital gain. Now, for the first $77,200 of capital gains, you will pay $0 in federal income taxes. That's a lot better than on the ordinary side of the house, as I just covered with you a couple of seconds ago. Now, if you're between $77,201 and $479,000, then any monies, any assets, any distributions of capital gains that fall within those channels will be taxed at 15%, and then anything over $479,001 will be taxed at 20%. So if you have a choice, you're better off taking a capital gain as opposed to an ordinary distribution. Now, notice on the left-hand side, and this will tell you that, now this is for married filing jointly, there's a large area there that is empty. Those are your deductions. For those of you that are married filing jointly for 2018, your deductions went to $24,000, almost doubled. So that means that if you happen to be anywhere between the 10, the 12, and the 22% tax bracket, and you're not maximizing your deductions, you're a fool. You need to start thinking and doing tax planning. And if you have IRAs and 401ks on the side, you need to start thinking about converting some of those assets in order to maximize those standard deductions that now the IRS is giving you the ability to use in order to take money out of your IRAs and your 401ks without having to pay taxes to the IRS, because you would be offsetting those tax liabilities with the standard and the increase in the standard deductions that you are receiving today. So if you don't know anything of what I'm talking about, go back to your accountant or give me a call so I can fill you in as to how to maximize those opportunities, not only now, but for the next 7 years. So every single year, for those of you that have assets in IRAs and 401ks, I deal with a lot of public safety employees that are already retired, that have a lot of money in drop accounts. You better start doing some Roth conversions, because the tax strain is going to come, is going to hit you hard, and you're going to be wishing 6, 7, 10 years from now that you would have started listening to me and putting money into your Roth IRAs and your Roth 401ks and your 7702 plans, and also doing Roth conversions in order to maximize your tax benefits in retirement while reducing and or eliminating your tax liabilities. Now, for those of you that are very close to the age of 70 and a half, you're going to have to deal with something that is known as RMDs, and those are your required minimum distributions. Basically, the IRS says that if they give you the ability to put money in a tax-deferred vehicle, like we did in the tax-deferred bucket, where the money goes in pre-tax and money grows tax-deferred, then when you pull the money out, you gotta pay taxes. Then the IRS at age 70 and a half basically says to you, listen, you don't have much longer to go in life, so I need to start getting my money now. Because remember, you enter into a partnership with the IRS when you put money into an IRA, into a 401k. Now, when you retire, the IRS gets to determine every single year what percentage of that partnership they're going to take for themselves. You have no control over that because it is based on their tax bracket, it is based on your tax bracket, and it is also based on wherever taxes are going to be in the future. Because remember, when you deferred that taxable income by putting money into your IRAs and 401ks, you also deferred your tax liabilities. So in this case, if you turned, let's say that you turned 70 and a half in 2019, you would take a look at all your IRA statements, all your 401k statements as of December 31st of 2018. And then you have to use a formula, which I'll share with you in a minute. In this case, the formula dictates that if this particular client had $500,000 at the end of December in 2018, then he's got to use the formula in order to determine at age 70 and a half how much money to take in 2019. So in this case, the formula is 27.4, and that is the uniform lifetime formula that you need to use once you hit the age of 70 and a half. And then you have to use that formula every single year. And then obviously 500,000 divided by 27.4, this client has to distribute $18,248 in 2019 because of the fact that he or she reached the age of 70 and a half. Now, for the first year and the first year only, the IRS gives you the choice of taking the money out in 2019 because of the fact that you hit 70 and a half, or they give you the opportunity to delay the distribution until April 1st, April Fool's Day of 2020. The problem and the definition and the decision-making process between taking the distribution in 2019 and 2020, it depends on the tax planning that you're doing. Because if you delay the distribution for 2019 until April 1st of 2020, then in 2020, you're going to be forced to take two distributions. The one for 2019 by April 1st, which you didn't take in the previous year, and then you also have to take the 2020 distribution by December 31st of 2020. So you have to be careful, and you have to know what tax bracket you're going to be finding yourself in retirement, because you have to go through the proper due diligence and exercise in order to do that. And this is how the uniform lifetime table looks like. Notice that every year you actually take a higher percentage. And the reason is that you're getting closer and closer to your mortality age, so the IRS wants to make sure that they get their money. For those of you that are public employees and you get a nice pension, I have clients that are generating north of $100,000 in pension income every single year. And with the 3% COLA that they're getting or higher, many a times, in 10 years from now, that income can be in anywhere between $170,000 and $180,000 of income. So therefore, that's going to take you to a much higher tax bracket. What if you have drop money? What if you have IRA money? What if your spouse has a 401k? You better start doing some Roth preparation and Roth tax planning and 7702 planning if you want to avoid those liabilities in retirement. Now, let me kind of walk you through the calculations, because many of you are going to be making a decision on your Social Security benefits in the next 5 to 10 years, perhaps even sooner. The challenge for most of you is that you make those decisions based on the amount of income that you're going to generate. So if you wait till age 70, you're going to generate more income than you would at age 65 or 66 or 62. And by the way, the reason for that is simple. If you delayed Social Security benefits until age 70, you have less time to go. So obviously your income distribution is going to be higher. But whenever I do any type of tax planning for a client, not only do I look at the income distribution, but I also take a look at the taxable disposition of your Social Security benefits. Because if you don't do it the right way, up to 50% of your Social Security benefits may be taxed in retirement. If you don't do any work whatsoever and you do it horribly, up to 85% of your Social Security benefits may very well be taxed in retirement. So the IRS every year has to do a calculation, and we do those calculations for our clients whenever we do any tax preparation for them. And the way that they're going to use the calculation is as follows. They're going to take 50% of your Social Security income for the year. To that, they're going to add your ordinary income. And that would mean any W-2 income that you had in that year, any 1099 income if you work part-time that you had in that year, any distribution that you had from your IRAs, your 401ks, your pension benefits will be factored into this calculation. To this, they're going to add all of your dividends and capital gains that you may have received in that given year. You sold a stock, you sold a piece of property, you generated a capital gain from that perspective. That will be added on to the calculation. And then last but not least, all that income that you received from your municipal bond funds or municipal bonds will be added on to the calculation. You see, if the only income that you had in retirement was Social Security benefits, then you would not pay taxes on your Social Security benefits. So the taxation of your Social Security benefits, it is not based on the Social Security benefit itself. It is based on all the additional income that has to be factored into the provisional income calculation that will determine what percentage of your Social Security benefits will be taxed as well. And the IRS has a formula that I'll share with you. If you happen to be single and all of these calculations that I just walked you through, and you are single, and all of those numbers add to less than $25,000, then you pay no taxes on your Social Security benefits. If it's between $25,000 and $34,000, then up to 50% of your Social Security benefits will be taxed in retirement, and then anything over $34,000, up to 85% of your Social Security benefits will be taxed. If you're married filing jointly, the numbers are a little bit better for you, but not that much. Under $32,000, you pay no federal income taxes on your Social Security benefits. Between $32,000 and $44,000, 50% is taxable. Anything over $44,000, 85% is taxable. So for those of you that have a pension, there's a very high probability that you may very well be over that threshold that we have just talked about. So it is very important that you understand how the rules of engagement work. And the reason why I have been paying a lot of attention to this is that when it comes to retirement distribution planning, ladies and gentlemen on this call, not all income in retirement is created equal. Let me give you an example using those calculations that we just went through. Let's say that we have a couple. They're generating $20,000 in Social Security benefits, and they're taking $40,000 out of their IRA for a total of $60,000 of income. But under provisional income calculation, remember that we're only using 50% of the Social Security benefit received. So $20,000, 50% of that is 10 added to the $40,000 in IRA distribution. So for provisional income and Social Security benefits calculation, the IRS, and we're only going to take a look at $50,000 of income. Once you go through all the calculations, you realize that in this situation, 55% of this family's Social Security benefit, or 55%, or $11,100 will come into taxation from a taxable standpoint. So because of the provisional income calculation, 55% of the $20,000, which is $11,100, will come and will be added on to the tax liability on the other side of the ledger. Now, let's go ahead and do the inversion of this calculation. Let's say that this family, instead of taking $20,000 of Social Security benefits, I was able to get the other spouse to take some additional Social Security, or actually take his or her Social Security. So now, instead of having $20,000 of Social Security benefits, we have $40,000. We still need $60,000 of income. So to that, we're just going to take, instead of $40,000 of IRA distribution, now we only need $20,000. So 40 and 20 makes 60. But because of the fact that we're using the calculation for provisional income, then the only distribution for provisional income will be $40,000, as you see there, as opposed to $50,000. Why is that? Well, because 50% of $40,000 is 20, plus the $20,000 of IRA distribution gives us a provisional income of $40,000. And in this case, you notice that the tax liability for these clients with the same income, $60,000 of income, in the second scenario, notice that the tax liability is only $4,000, or 10%. So that means out of the $40,000 of Social Security benefits, only 10% of it, or $4,000, will be taxable in retirement. So at the end of the day, when you really start doing tax planning, you have to do those tax forward plannings for years down the line in order for you to be able to understand what your tax liabilities are going to be in retirement, and what can you do today, especially over the next 7 years, in order for you to be able to minimize that tax liability and or eliminate that tax liability in retirement. And how does it look on a return? Well, take a look at it. See, the first couple had a tax liability of $2,559, just a little bit north of $200 a month. The second couple had a tax liability of $0. So the question is, what can you do with an additional $200 a month? Well, that could be a car payment. That could be an electric bill payment. That could be a night out with your family. That could be additional savings. That could be an additional investment. That could pay for an extra vacation or a long weekend. So there's a lot of stuff that you can do if you're able to minimize. And by the way, all of these calculations that I just ran for you, did you have to take any additional risk in your investments in order to accomplish what I have just shared with you? And the answer is no. So tax planning does not require any type of risk. But if you don't do tax planning, then you're going to pay the price not only now, but you're also going to be paying the price for many, many years in the future. And it can only get worse. And then obviously the other issue with provisional income is, and understanding, why it is so important for you to maintain the optimum amounts of money in your taxable bucket and your tax deferred bucket, is that all that income that we took into consideration, except for the Roth IRAs, the Roth 401ks, and the 7702 plans, can actually increase your Medicare premium in retirement. So for those of you that have been putting money away in IRAs and 401ks because everyone kept telling you to max out those contributions, well, now you may very well be paying the tax, because it's not just the liability of paying the tax on whatever you're distributing out of those accounts. It's the fact that now your Social Security benefit may be taxable and your Medicare premium may be even higher because of the fact that you may have no choice but to take money out of those accounts. So it is critical to understand, how do you mitigate all of those circumstances in retirement. So again, as we come to the very end of this short webinar, if you're interested in more information and you would like to have a confidential consultation with me, in order to figure out if a customized tax planning blueprint may be suitable for you and your family, please feel free to reach out. Now, when you do, there are 4 questions I'm going to ask you. Number 1, what plans have you done to triple your income in retirement? Because between taxes and inflation and market volatility and interest rate volatility and longevity planning, you're going to have to triple your income. Otherwise, you're going to run out of money before you run out of life. So I'm going to find out, I need to find out what have you done along those lines. I'm also going to ask you, what would happen if the stock market dropped another 45% like it did in 2003 and 2008? How are your retirement assets protected? Do you have a principal protection plan in place in order to mitigate those liabilities? Another question I'm going to ask you is, what have you done to protect yourself and your family, from that market volatility that is so critical for all of you? And then last but not least, I'm going to ask you, what plans have you done to protect yourself and, again, your family from a long-term care situation like Alzheimer's, Parkinson's, or stroke, or many other issues that are going to be very detrimental to you and your family in the future. Now, for those of you that are thinking and debating whether you need to reach out and call me, well, if you're interested with your taxes and your CPA and your accountant can do tax for planning, there's no need for you to reach out to me. If you already have a fail-safe retirement plan, there's no need for us to talk. If I'm more interested in your success than you are, please don't bother me. I don't need the aggravations, and neither do you. And if you happen to be a family member in the business that does tax planning and that does, insurance and alternative investments, then it's probably not a good idea for you to reach out to me. Now, why we should meet? Obviously, if you want to minimize your taxes and maximize your Social Security benefits, definitely. If you want to create a fail-safe retirement plan, absolutely. If you want me to audit whatever it is that you may have already done, because many times when I engage clients for the first time, they have already done some things, but they need a proper audit of everything that they have done, then obviously I'll be more than happy to help you with that. If you want to create a comprehensive retirement blueprint, and then obviously if you're truly concerned about your retirement affairs. So that's very important. My call to action as I leave you tonight is, the definition of insanity, right? Doing the same thing over and over again and expecting a different result. So if you've been doing the same things for many, many years and you're expecting a different result, the probability that that's going to happen is going to be slim to none. So take it upon yourself to reach out to me. It's going to be a 30-minute video conference, or we can do a 30-minute conference call. There's no cost or obligation, so you're willing to and you're able to pick my brain and ask me any questions that may be keeping you awake at night from a business standpoint. Obviously, feel free to call me. If you have your cell phone and you don't have a piece of paper, take a picture of that slide there. You can reach out to me at area code 786-766-1042. You can also email me at Bert, B-E-R-T, at GablesTaxGroup.com. You can always check out my website at www.gablestpg.com. But most important, I want to thank you. I want to thank you for giving me an opportunity to spend a few minutes with you tonight. And I want to leave you with a type of thought that I leave all of my clients whenever I do a webinar, seminar, or podcast, which we do on an ongoing basis, is that my number one goal is to help you and your family kind of change the way that you see things. Because when you change the way that you see things, the things that you see change. And as you were able to tell tonight, based on all the information that I was able to share with you, when it comes to retirement distribution planning, the rules of engagement totally change. The vast majority of you and the vast majority of Americans have never had an opportunity to do tax planning and have never really thought through all of the different issues and concerns and the challenges that you're going to have to deal with at some point in time in your life. So again, thanks very much for giving me a few minutes of your time. feel free to reach out, pick my brain, whatever topic you want to discuss, and I'm looking forward to talking to you again next week. Take care, have a good night, and see you soon. Bye-bye.